Alternative investments. The top performing alternative investment ETF so far this year has returned 182%. That's way more than the S&P 500, which only had a 24% return so far. It's no wonder that 81% of all the ultra wealth individuals investors invest in alternatives, right? So what exactly are they investing, and why do those who have over $30 million in assets invest 50% of those assets into alternatives? What do they know that we don't know? Well, one thing's for sure, unless we're making over $200,000 a year and have over $1 million to invest, we're completely blacklisted. Or are we? In today's video, we go over what the ultra wealthy are buying, what we can buy, and how we should evaluate these wonderful things called alternative investments. All right, first, what is an alternative investment? Well, broadly speaking, alternative investments is anything other than listed equities, bonds, or currencies. This realm of alternative investments can include things like fine wine, baseball cards, vintage cars, real estate, private equity, private credit, cryptocurrencies, structured products, NFTs, the metaverse, pretty much anything that you can put money in that's going to appreciate in value, that's an alternative investment. Now, why do those who are ultra wealthy invest in these things? Well, the most common reason that people invest in alternatives is to gain exposure to a market that's not correlated to stocks and bonds. These items can be not correlated to pretty much anything at all and everything, depending on what you want. You can get things that are highly correlated to economics, like interest rates, or things that are highly correlated to maybe supply chain, or things that are highly correlated to speculation. These things are not available from regular listed equities. For example, BDRY, which is that wonderful fund that I spoke of that gained 182%. The fund offers investors unlevered exposure to dry bulk freight without the need for a futures account. So here we go. Here's something that you can invest in, that the ultra wealthy might invest in, that you can get 182% return. But that's not the whole story. So don't go out and look and see how much money this thing can make you. It's actually done really poorly if we were to look at it from its inception. From its inception, it's gained something like negative 0.62%. So this is definitely not a buy and hold product. It's more of a product where you need a directional bias and you need to be right more than wrong, because 182%, you'd have to have bought it in the beginning of the year and potentially have already sold it because it has dipped over the past month. Now, it's definitely different from your standard S&P 500 buy and hold strategy. So what exactly are the ultra rich investing in? They must have some kind of portfolio. Well, they do. And according to KKR's research, this is what their money is invested in. The ultra high net worth invest about 31% of their money into listed equities, 10% into fixed income, 50% in alternatives, and 9% into cash. And the interesting part is that, and this is where this might help you in some way, is that the ultra rich are actually purchasing more money or putting more money into alternatives because the stock market is so overvalued in their opinion. It might not be overvalued in your opinion, and you might always just say, oh, but we can buy the dip. But what the ultra wealth and what a lot of folks are saying is that because the stock market is so overpriced, they're looking at other assets that could potentially have more upside. And alternatives being one of them that's non-correlated is the place where at least the ultra high net worth folks are putting their money into. So which of these alternatives are the ultra high net worth individuals putting their money into? The studies show that from 2017 to 2020, more and more of this money has been going into private equity and real estate. And they've actually been cutting back on their hedge funds exposures. So don't buy hedge funds. Let's look into private equity and real estate. Interestingly, the only asset class within the alternative space that outperformed the market was private equity. In 2020, private equity returned 27.8%, while the S&P 500 returned 18.4%. And if we were to use a longer period of 20 years up until January or June 30th, 2020, we would find out that the private equity produced an average return of about 10.48%, which beat the S&P, which returned 5.91% during that same period, and the Russell 2000 of 6.69%. Now these numbers again are probably skewed in favor of private equity, but private equity, as you can see, has returned pretty favorable returns as far as the investment space goes. All right, Matt, so we know now that most ultra high net worth folks will invest in alternatives. We know that they invest most of their money into private equity that has provided them with the most return and sometimes perhaps beats the market. So what is private equity? As you can see in this diagram, it's headed by the general partners, and the general partners are like, you can consider them like the managers of the fund. They own 1% of the fund. 99% are partners, and these partners are things like pension funds, foreign sovereign governments, government pension funds, and individual accredited investors. Now, this 100% of the money goes toward buying different types of investments. And what do these investments contain, or what are these private equity firms buying? Well, they're buying things like distressed companies. These are companies who filed bankruptcy or they're having managerial problems or financial problems. They also buy things like leverage buyouts, which is actually the most popular form of private equity, where they completely buy out a company, revamp their workforce, revamp the management staff, and turn an investment over for their shareholders. The next type is real estate private equity. And a real estate private equity is kind of lumped in with real estate, as real estate being more of like owning houses outright. Real estate investing, when it comes to private equity, is the equity company buys like a residential property or residential development or commercial development, and they hold on to it and kind of redevelop it and turn it into some either rental space or sell it like a flip for a property sale. And lastly, venture capital, which is not the most popular alternative investment, but it is one that private equity does from time to time purchase. Now, one of the main problems with private equity, and also the reason why we probably have this accredited investor restriction, is these funds are locked up typically for 8 to 15, sometimes even 20 years, where you can't touch the money. You might write a check for a couple $100,000 and not see that money until 10, 20 years down the line, where they send you another check for about $1 million. And that can be really scary for folks, especially if they don't have any way to really track it other than the tax forms that come. So that can be very scary for people, especially for those who are more accustomed to seeing their account, dip and rise every single day. So that can be one of the major disadvantages of private equity. But can't you invest in private equity on ETFs? That's true, but not completely telling on the whole story, as the private equities ETFs are not that many, and they also don't perform that well, because you can't get the true ability of private equity unless you are actually writing a check to a company that is actually taking the money and buying out these other distressed companies or buyouts and such. I do need to ask you to hit the like button if you do enjoy this type of content, and let me know in the comments below if you want more of this content or what other types of content you'd like to learn about in the realm of finance. And I'll see you in the next video. And you won't know until it's the very end.